Welcome to the Stock Market Palantir. Today we are going to talk about AMD.
The one and only.
Exactly. Advanced micro devices has been, well, the absolute focal point of the semiconductor supercycle and frankly of the entire tech sector as we're closing out 2025. The stock's been trading very aggressively. It's hovering in that, 215 to 220 range, following just a stunning appreciation, nearly 97% year-to-date. This isn't just, speculative froth. It's a powerful convergence of genuine, breakthrough fundamental validation in AI colliding with some extremely complex market structure dynamics that we really need to unpack.
It is certainly the most talked about and probably the most polarizing name in tech right now. And that appreciation, it's been stunning, but that's precisely where the central tension lies. I mean, the critical question we have to ask is whether this powerful new technological foundation AMD has built, which, let's be clear, we both acknowledge is real, truly justifies this aggressive valuation and the sheer momentum, or if the underlying market mechanics and, frankly, the persistent execution risks suggest that this whole rally is built on a foundation that's maybe a little too fragile for comfort.
See, I hold the view that the recent strategic wins are truly transformative. They've fundamentally de-risked the stock. They've provided concrete, undeniable evidence that AMD is now a foundational infrastructure player. So these events have, in effect, raised the long-term floor for the data center division, so I believe this momentum is justified and the stock is poised for meaningful moves toward the consensus fair value, which, clusters around $270.
And I come at it from a very different angle. While I'll concede the fundamental improvements are strong, they absolutely are. The price action right now just appears technically overextended. The valuation is frankly anomalous compared to its peers. And there are critical signals within the market structure that point toward institutional distribution, selling pressure, in other words. And that, coupled with very real supply chain headwinds, just mandates extreme caution. Chasing this thing above 215 carries substantial risk.
Okay, but to understand the optimism, you have to accept the fundamental shift that's happened. For years, the core bear thesis against AMD was the software moat. The skeptics argued that ROCm, their open-source stack, would just never be mature enough to seriously challenge NVIDIA's CUDA, especially not in high-demand frontier-scale model training. But we have now moved from roadmap promises to silicon reality, and that argument is being systematically dismantled.
Right.
And the key evidence for this shift is the Zyphra Xia 1 milestone that was announced just this month. This wasn't some small proof of concept. Zyphra trained a large-scale 8.3 billion parameter mixture of experts model, an MOE model, trained entirely on AMD Instinct MI300X accelerators. It's profoundly significant. MOE architectures are extremely demanding. They stress the whole system, memory bandwidth, inter-chip connectivity, the whole fabric, far more intensely than standard models. The fact that the ROCm stack supported this kind of high-demand training proves its maturity. This event is a massive, structural de-risking event for institutional capital. It effectively kills that software tax narrative.
I agree completely that the software tax bear thesis is wounded, if not completely dead. The Zyphra validation is powerful. It proves the stack can handle large, complex workloads, which was a critical hurdle, no doubt. But the market didn't just price in validation, it priced in immediate, massive, multi-year revenue, which then brings us to the partnerships. That reported OpenAI partnership, potentially valued up to $10 billion over time, using the next-gen MI450s. That's monumental.
Monumental is the right word.
It is. This is an industry kingmaker, committing gigawatts of compute to AMD. It establishes them as the confirmed high-confidence second source. So that provides a multi-year revenue floor well into 2027, 2028. You can't overstate the significance of that stability. But, and here's the pivot, I agree this is a game changer for baseline revenue, but the current aggressive price action is not justified by the rate of that revenue recognition. The enthusiasm has, outpaced the reality of the balance sheet.
Why do you claim the enthusiasm has outpaced the reality? We have evidence of the tech working and confirmation of massive orders.
Because of the cost of entry right now and the valuation multiples, I just don't buy that this $220 price point is purely fundamental.
We have to address the static metrics. So despite the stellar forecasts, the trailing price-to-earnings ratio is exceeding 100. We're seeing quotes between 106 and 113.
But relying purely on trailing PE in a hypergrowth environment is so misleading.
It is static, yes, but it serves as a warning flag. Compare that 100-plus multiple to NVIDIA, which is trading at a PE of around 53. Now, I acknowledge AMD's trailing PE is distorted by heavy R&D and the amortization from the Xilinx acquisition, but that multiple still signals an extreme, almost maximalist forward-looking optimism. The market is pricing in flawless execution for the next 2 years.
That's an interesting point, but I'd frame it differently. The high trailing PE is deceptive precisely because the company is in an extreme growth phase. The valuation reflects the acceleration of future earnings, not the current state. Management has guided toward a 60% compound annual growth rate, a 60% CAGR for the data center division. So if you factor in that projected growth, the forward PE compresses dramatically. When you look at the PEG ratio, the price earnings to growth, which is how analysts justify these high multiples, AMD looks compelling, possibly even undervalued compared to peers who are starting to, confront the law of large numbers. We're paying a premium for accelerating revenue and market share gains, which warrants a high multiple today.
I see why you emphasize the PEG ratio. I do. But I have to question the sustainability of that 60% CAGR input. That is an enormous figure to maintain as the revenue base expands. And crucially, I question the sustainability of that growth without margin compression.
Okay.
To capture what their targeted 20 to 30% of the AI market, AMD has to compete fiercely, and that competition is going to be waged primarily on price and total cost of ownership, TCO. That means they might have to suppress gross margins significantly below what investors are used to seeing from the dominant player. So if the revenue targets are hit, but the profitability is disappointing, say gross margins in the low 50s instead of the high 50s, that 60% CAGR thesis can unravel very, very quickly.
Margin compression is a legitimate long-term concern, but let's not forget the immediate execution risk that kind of grounds your cautious stance. The supply chain. If AMD can't get the chips built, the growth targets are meaningless.
Precisely. The reliance on TSMC for CoWoS packaging capacity is the major risk for 2026. CoWoS, that's chip on wafer on substrate. For the listener, this is the critical bottleneck. It's the extremely complex 2.5D stacking technique TSMC has to use to integrate all the chiplets, the logic, the high bandwidth memory into one powerful package. If TSMC can't ramp CoWoS capacity fast enough, those billions in MI300 and MI450 orders simply cannot ship. That execution risk, even though it's external, it hangs over everything.
That is a critical constraint. But let's pivot to market structure, because flow dynamics are influencing the short-term price far more than CoWoS right now. FINRA data consistently shows high off-exchange short volume, right? Often exceeding 47%. A lot of retail investors see this and they think institutions are secretly shorting the stock. I'm just not convinced by that.
I agree that the interpretation of high daily short volume is often flawed.
When massive retail order flow comes in, the so-called YOLO trades, the market maker has to facilitate that trade. So they do this by transactionally shorting the stock to the retail buyer. Then they cover moments later. This is the mechanism that allows enormous retail demand to be absorbed without spiking the price on the lit exchanges. And the low overall short interest, around 2.5%, confirms this is transactional, not directional.
Okay, I accept the transactional shorting explanation. It's a necessary mechanism. But dark pools serve another, far more important purpose: institutional block trading. And that's where the risk lies. I mean, large asset managers who got into AMD at lower levels are now looking to rebalance and lock in profits. The remarkable stability of the stock in that tight 215 to 220 range, despite massive volume, it strongly suggests that institutions are using those off-exchange venues, specifically using midpoint peg orders, to systematically sell into this retail-fueled strength. A midpoint peg order executes a huge block trade at the exact middle of the bid-ask spread, which minimizes its price impact, so it reduces volatility while they sell huge amounts of stock.
And you believe this constitutes institutional profit-taking?
Absolutely. This behavior is characteristic of the distribution phase. Ownership is transferring from those early fundamental-driven institutions to late-stage momentum chasers who are, less sensitive to valuation. So the high dark pool volume isn't just retail flow, it's masking massive institutional selling, minimizing the volatility while they quietly unload into this technical exuberance.
Let's pivot to the strategic future then, because that dictates who ultimately wins this distribution game. AMD's long-term thesis isn't about selling individual chips. It's about selling integrated solutions. They're focused on the inference war of 2026 and their vertical integration strategy with the Helios rack-scale AI platform.
Right.
The MI300X's hardware advantage is critical for inference, running the models. Inference is cost-sensitive, it's memory-bound, and that 192 gigs of HBM3 gives AMD a massive advantage. Our analysis shows that the TCO dictates a shift. AMD's hardware can run larger models on fewer chips. For hyperscalers like Microsoft, Meta, or Oracle, if AMD can offer comparable performance at a significantly lower cost, the economic argument just becomes overwhelming.
The TCO argument for inference is fundamentally solid, but implementing Helios, that integrated rack of GPUs, CPUs, and DPUs, requires a level of coordination that rivals have spent decades perfecting.
But that integration is precisely how AMD plans to capture margin and increase stickiness. By providing an optimized, unified, pre-validated solution, a full rack, they stop being a component vendor and they start being a system vendor. It makes it much harder and more costly for customers to switch away.
That strategy is sound, but the timeline for that revenue to materialize is long. And in the short term, the price is heavily influenced by the behavioral risks fueled by retail speculation, which accelerates the stock far faster than the fundamentals. You mentioned the YOLO crowd, and that leads directly to the advanced money destroyer psychology. The tendency of the stock to run up violently and then just consolidate sideways for ages, punishing short-dated call option buyers. And this dynamic creates a volatile speculative engine. Traders often ignore the 100x PE, and they anchor instead to these, psychologically important round numbers like 250 or 300, driven purely by the narrative. This generates huge option open interest at high strike prices, and that options overhang creates a volatile gamma environment that can drive these sharp, unsustainable moves upward, making the stock extremely prone to severe pullbacks when sentiment inevitably reverses. The stock needs to stabilize, not be driven by call option fever.
Okay, we've covered fundamentals, market structure, strategic future. But before we wrap up, we have to address one point that's caused unnecessary anxiety in the retail community: the noise about a reverse stock split. This needs absolute clarity.
I wholeheartedly agree. This administrative noise has been misinterpreted as a sign of corporate weakness, which could not be further from the truth.
Let's be very clear. The chipmaker Advanced Micro Devices, AMD, has not executed, proposed, or announced any reverse stock split.
Exactly. The confusion is solely related to an administrative action taken by a derivative fund, the Yield Max AMD Option Income Strategy ETF, which trades under the ticker AMDY.
Right. AMDY announced a 1-for-5 reverse split in late November. That ETF uses a synthetic covered call strategy to generate high yield. Those payouts mechanically erode the fund's net asset value over time, so the reverse split was just a procedural move to keep its share price in a tradable range.
It has zero bearing on the corporate health, revenue, or outlook of Advanced Micro Devices, the chipmaker. The corporation itself is fundamentally robust.
If anything, the relevant speculation for AMD itself, with the stock price well over $200, is about a potential forward stock split, which would generally be seen as a bullish catalyst, making the stock more accessible.
A much more likely scenario.
So to summarize my position, AMD has systematically de-risked its thesis. The Zifra model validated RoxM, and the colossal OpenAI partnership cemented AMD as a foundational infrastructure player. These wins have raised the stock's fundamental floor, and the current momentum is justified as it moves toward that, long-term 270 consensus value.
And my view remains one of necessary caution. While the software moat is breached, the valuation is stretched, trading at over 100 times trailing PE, which signals maximal optimism with zero room for error. We face significant execution risks with TSMC's CoWeos capacity for 2026. And the market microstructure, specifically the hidden distribution happening in dark pools, suggest early institutions are quietly selling into this retail-driven exuberance.
So we agree profoundly on the fundamental shift in AMD's competitive positioning, but we diverge sharply on the interpretation of the current valuation and the market flows. The material certainly provides strong arguments for both caution and aggressive accumulation.
Absolutely. Understanding the dual nature of these pressures, the incredible fundamental breakthrough set against the speculative and technical mechanics, is essential for anyone navigating this stock today.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights. And see you in the next video.